Hi, everybody. Thanks again for tuning in 5 Minute Finance. My name is Colin and I'm a financial advisor here at IHT Wealth Management in Chicago. We're coming back from a little bit of a break. It's been a pretty eventful past couple weeks in both the market and in real life. So, along with that, a lot of people have had a little bit of free time on their hands to pay more attention to maybe things in your life, such as personal finance. So with that in mind, I want to take the time to put together a video about the Back Door Roth IRA strategy. It's really it's a quick, easy strategy that you can use. It's not hard to execute, very easy to pick up the phone and get done. But in the long run, it will really, really help take advantage of the different tax treatments of retirement accounts, and it'll just help you kind of grow that nest egg in the long run. So just for some context, I want to talk really quick about the difference between traditional and Roth IRA. Traditional IRAs are very similar to a lot of 401k plans that employers offer. So it's pre-tax dollars that go into the account, right? So what it really just means you don't pay tax on that money, right? And then you invest it in whatever you would like to. You wait for 20, 30 years, whatever suits your situation when you're ready to retire, and then you start drawing and taking withdrawals from that account, and you use it as income. And when you do that upon retirement, it's taxed as ordinary income. And Roth IRAs are pretty much the complete opposite. You use after-tax money to fund the account, right? So that's after the IRS gets their cut already, and then you invest it, you give your 20, 30 years, same thing. And on the back end, when you go to use that for your income and your retirement income, it's completely tax-free. So, and that's the situation that we want to look to take advantage of right now. So the downside to Roth IRAs, however, are after a certain income level, you are no longer able to make contributions to that. So for example, single filers, once you make $124,000, they begin to phase out what you're able to contribute to your Roth IRA. So, and then kind of regardless of Roth versus traditional, the contribution limit for 2020 for individuals under 50 years old is $6,000 regardless. So that applies to everybody, you and me, that is under the age of 50. All right, and now that we've kind of set the stage, I want to give you kind of a visual as to the difference that this strategy makes as compared to just funding a regular traditional IRA.
All right, so with that in mind, right, we have the $6,000 annual contribution limit. So I want to take that and just kind of give you a walk you through, right? If you were to deposit that in a traditional IRA and give it 40 years, what that will look like, and then just kind of show you the advantage of using the backdoor Roth IRA strategy. So we'll start with that $6,000, right? So let's say you take this $6,000, you deposit it in a traditional IRA, and you invest it in an equity-based growth portfolio, right? So let's give it 40 years at 7% annual compounding. The S&P 500 is an annualized return of just under 10%, so I feel comfortable using 7 as a pretty reasonable number here. So if you give it 40 years at 7% annual return, you wind up with $90,000 at the end of that, right? And just for simple purposes, let's say that that's what you need for retirement income, right? So you need 90 grand to live. That would put you in the 24% tax bracket. So now the IRS takes their 24%. You're left with $68,400, right? Which is good. That's not bad at all. That would go a long way for most retirees, right? That should be great for most retirees, but we can do better. So now let's say we deposit that same $6,000 into, let's say we're going to use this backdoor Roth strategy. So the way that works is you initially deposit it into a traditional IRA, which is easy start. So then from there, you roll it into a Roth IRA, and when you do that, it triggers a taxable event. So you will have to pay income tax on that $6,000, which in this case, if you're above that $124,000 threshold, I just want to use the 32% tax bracket. So that would put you at just shy of $2,000. So if you are able to pay that $2,000 out of pocket, that is the only way that this method is beneficial. So you pay that $2,000 out of pocket, $6,000, you now have $6,000 in a Roth IRA account. So now you give that same 40 years of compounding at 7%, you are left with $90,000 in purely tax-free money. So just doing this in year one, that's giving you just over $21,000 in difference, right? And so, as you get closer, as that 40 years goes down, that number, that difference will shrink. It'll decrease until you hit zero. So as you get closer, this method as you get closer to retirement, this method certainly has its drawback. It becomes less effective, but it's still, $21,000 is great. So if you do that year one, maybe it's $20,000 in year two. You're saving $19,000 in year three, and it adds up very quickly over time to where, it's very conceivable that using this strategy could add hundreds of thousands of dollars onto your, IRA, your retirement nest egg. So, that's that. I appreciate everybody for tuning in. As always, if you have any questions, concerns, comments, heartaches, anything like that, leave them in the comments below, and thanks for tuning in.